Hello everyone, today is December 6th and what I'm going to show you today in this video is the January effect. How do we predict the upcoming year 2022? Will it be an up year or will it be a down year? I'm going to show you exactly how we do that, and this video will be probably the first in a series of videos explaining more and more on prediction coming into the new year. What you're seeing here on the chart is the Trade Scalper software. The Trade Scalper software is available at DayTradeToWin, and you can see that there are a few signals here to go long, to go short. It's about 3 o'clock Eastern Time, New York time, so the most recent signal, 45.91 quarter, to go short. This is a short opportunity as we speak. Before we begin, remember that trading is risky. Please don't trade with funds you cannot afford to lose. Talk to your broker. Understand there are risks involved with trading. So when we take a look at the year as a whole, there's a lot of opportunities as an investor, as a day trader, as a swing trader. The idea here is to look at how we can take advantage of whether we should buy, how we should sell, or the timing of buying and selling. So let's look at a daily chart, and let's start off with this prediction model using the January effect. All right, let's look at how we can forecast the following year. I'm going to teach you the January effect. I'm going to put out a few more videos on this method. It's completely free for everybody to learn and understand. Email me if you have any questions on how this works. Essentially, it's more of a long-term investing or even for day trading, as long as you understand how we can utilize this. I'm going to see if I can do a live webinar as well, as long as everyone is opted into the Day Trade to Win email list. Just visit DayTradeToWin.com and you'll opt in to get notification when we have these live events. So I'm looking at a daily chart, and you can see that the market is heading for pretty much the entire year here, higher and higher and higher and higher. But there is a way that we can find out when and how and exactly where we should be buying the market. So the first thing we're going to do here to start off is look at the January month, whether it opened and closed higher or whether it opened and closed lower. So basically, let me just add a little bit more days here to the market, to my chart, and we're looking at here the beginning of January, which is January 4th, and looking at February 1st. So did, in fact, January close higher than open? And you see here is where January opened, and here is where we have February 1st. So exactly 1 month. Not that much of a dramatic difference, but it's about 20 points here on the EMA and the S&P, and you can use this method on really any financial market. It works the same way. So about 20 points, the market did in fact go up. So we have here, in essence, a month that started and ended here higher. Now, anytime throughout the year, as we continue to push forward, we're going to see if we can buy the market. And there's two ways that we can buy the market. And then if you want to look into day trading during these times, we can also do that as well. And I'll cover that in more detail in future videos. So the idea now is, first, will each highest high be broken, and by how much? So for example, here is the highest high, the price 34.75, right? Just about here is the highest high. When this is broken, there is an opportunity to be a buyer, because with this January effect, it's probably 80%, 85% accurate or more that I've seen this work year after year, where if there's a higher closing month of January, we'll see the market just move higher throughout the year. But we just can't hold the market and hold on to it because these are very big swings, very large swings. So we're going to take advantage, if you're a day trader or if you're an investor or a swing trader, as soon as the market breaks the highs of January, take advantage of it and be a buyer and start trailing a stop. And so this is a great opportunity to be a buyer. And it happens again. Here's the new high in February, and as we get into March, here is March 1st, as soon as we see it break again have an opportunity to be a buyer. Now down here you see the ATR, the average true range. This is a good starting point to see what kind of profit you can make, whether it be 50 points, 80 points, 70 points. Doesn't really matter. Just take a look here to see if there's something that can be made. This is about 24 points and it went higher. Now in April, this is April, take a look at April and see where is the highest high in March, and did it break? It broke, and here we have another opportunity to be a buyer. So now we take a look at the highs of March, and you can see here in April it started to break up, actually on April 1st, believe it or not, and we have an opportunity, whether it be on this candle or this candle or this candle, it just kept on going and going. So here's another opportunity, whether you take a look at the March high and then right away go into, which is a little bit higher here, in April 1st or even April 2nd, it's a great opportunity. And then we see here once again from April to May. I mean, I can do this every single month. Here's another opportunity, and here the market hit and broke through the highs and immediately reversed. So at this point, if you are long in a trade and the very next day closes back down, get out of the trade, right? It's obviously it broke through but didn't continue. It's a way that we use prove it stops, proof that the market's not going in our favor if it closes right back down. And then we have here in June, here's the highest highs. Once again, once it broke, it just kept on going. Same thing here in July, and so on and so on. Here's just a quick explanation of how this works. Here is the highest high in July. Once again, it broke on July 1st as well as July 2nd. Just kept on going. It doesn't really matter which one that you went long on. It never closed back below the June highs. Okay, that's one way to take advantage of it. The other way to take advantage of it is to look at every single pullback that occurs, and it has to be a significant pullback. Usually I say 3 or 4 days. 4 days or more, probably better, right? So the more the better. So you see here is a great little pullback, here's a great little pullback, here's a great little pullback. This here is only about 3 days. I'm not sure I would count that. Here is a great pullback, and here is another one, which leads me to where we are right now. And as we end the year in 2021, I am going to look for an opportunity to be a buyer as it comes back to test and break the highs of November. So we do have an opportunity here to be buyers as we end the year, and then we do this all over again for 2022. The next video, I'll go into more detail on exactly where to get in on these retracements, because even though the market retraces, we still have to really pinpoint and time our entries to the long side correctly. So it's not just looks like it's coming back up and we jump in. We need some proof or some evidence. My name is John Paul. The next mentorship class begins tomorrow, and then we have one more mentorship class scheduled before the end of the year. If you're interested, let us know. Take a look at the website for the upcoming dates. Feel free to call us and find out if this program is right for you. Until next time, I'll see you in the next video. If you're new to day trading and want to learn more on the benefits of trading the markets, visit DayTradeToWin.com, join the next mentorship class starting later this month, and subscribe to the Day Trade to Win YouTube channel. We focus on price action and work exclusively with new and beginner traders who want to learn more on how to prosper from trading.